Here is the number that should make you sit up today. China's yuan has just touched its strongest level since February 2023, while the 10-year government bond yield has fallen to 1.68%. Those two moves rarely happen together. On Wednesday, August 19, 2026, Commerzbank put a name to the concern. Policy support is now being eyed because growth is slowing. The currency is saying one thing, the economy another. Analysts are watching because a strong yuan, without domestic policy changes, usually means weaker Chinese growth. July's data makes the tension clear. Chinese banks' net client foreign exchange sales have to an 8-month low of $25.2 billion. That means companies are converting foreign earnings into yuan far less eagerly, so the rally is not being driven by real underlying demand. The People's Bank of China has been making it expensive to bet against the yuan, which stabilized the currency but has now overshot into strength. At the same time, the 10-year bond yield falling to 1.68% shows investors are buying Chinese government bonds, pushing prices up and yields down. Normally, a stronger currency would come with firmer yields. This rare divergence suggests money is piling into safe Chinese assets while the domestic economy cools. Brad Setzer captures it. Stronger yuan without domestic policy changes most likely means slower growth. The impact cuts both ways. A stronger yuan makes imported goods, commodities, and overseas travel cheaper for Chinese households, and keeps imported inflation low. But for China's massive export sector, it is a squeeze. Every bit of currency strength reduces competitiveness in Europe, the United States, and emerging markets. Slowing corporate conversion is another sign that the real economy is not as confident as the currency move implies. For global investors, China is a demand bellwether. If Beijing steps in with fiscal or monetary support, that could underpin commodity prices and global demand. If it does not, the strong yuan becomes another drag on the world's second-largest economy. Commerzbank's note points squarely at policy support as the next move. The form could be a reserve requirement ratio cut, lower lending rates, more infrastructure spending, or direct signals that the central bank wants to slow the yuan's appreciation. The rare combination of a rising yuan and falling bond yields cannot last indefinitely. Either stimulus arrives and growth expectations stabilize, or bond inflows fade and the yuan gives back some gains. Watch the Pboc daily fixing and any state council comments. Also watch whether July's weak corporate conversion continues into August, because that would confirm the private sector is hedging against slower growth rather than betting on yuan strength. The lesson from today's price action is simple. Do not mistake a stronger yuan for a stronger economy. China's currency strength is partly a policy artifact and partly a flight into bonds as growth slows. Beijing may soon have to choose between currency stability and growth support, and early signs suggest growth support is winning. For traders, the key levels are the yuan's February 2023 high and the 1.68% bond yield. For everyone else, watch for Chinese stimulus headlines in the coming days, because when the world's second-largest economy reaches for the accelerator, global markets feel it.